When's the best time to invest your money? That's a question that pretty much everyone has at some point in their investing journey. Should you invest once a month, once a week, whenever you have the extra money? Does the day of the week that you invest matter, or the time of the day? The simple answer to all of those questions is that you should be investing as much as possible, as early as possible, and you should be investing consistently over the long term. And the more detailed answer, that's what we're going to be covering in this video. We're going to be breaking down two popular investment strategies, which is dollar cost averaging and lump sum investing. Before we get into it, we want to mention that our personal investing philosophy is all about long-term passive investing in the stock market. So basically buying and holding well-diversified investments like ETFs. So with that in mind, let's get into it. The first investing approach that we want to talk about is dollar cost averaging. Dollar cost averaging is a strategy that involves investing a set dollar amount into the same investment option on a consistent basis, regardless of the current price of that investment. For example, you might invest in the same ETF every single month on the first of the month, no matter what the cost of that ETF is on any given first of the month. Dollar cost averaging takes advantage of the fact that the market is sometimes up and the market sometimes down, but generally it trends upwards over the long term. So with this approach, you're consistently investing at a predetermined frequency, like once a month, regardless of if the market's currently priced higher or lower on that specific day. Basically, no matter what's going on in the market, you're investing the same amount of money on a regular basis. And by doing that, you're taking advantage of the times when the market's down, even if it means sometimes investing when the market's up too. Now, historically with this strategy, your investments will average out, allowing you to benefit more than you lose by taking advantage of the times when the market's cheaper. Here's a simple example of how dollar cost averaging works. So let's say that you plan on investing $1,200 into one ETF in 2025, and there's two different ways that you could go about it. You could either invest all of the money in January 2025, so assuming that you have the whole $1,200 at that time, or instead, you can invest $100 a month all throughout the year. Investing $100 a month would be dollar cost averaging, and here's how it could turn out. We're going to share a chart on screen that shows the share price per month and also how many shares you'd be able to afford to buy with your $100 given that month's share price. You can see that the share price fluctuates every month, going up and down slightly. Now keep in mind that this is just an example, so with random numbers in mind, but this is accurate to what happens with stocks in real life, right? There's going to be slight fluctuations every single month. So in this example, taking the different share prices and the amount of shares that you could afford per month into account, you would have ended up saving about 42 cents per share by spreading out your investing throughout the entire year using a dollar cost averaging approach instead of investing all of your money in January. That means that if you invested $1,200 at $10 per share in January, you would own 120 shares. But because you invested $100 per month, the average price per share ended up being $9.58, meaning that you'd owned 125.24 shares instead. Now, in this example, the share price went up and down, but in reality, we of course don't know what the share price is going to be on any given day, let alone over the course of an entire year. So in theory, the share price could have went up each month, resulted in you actually having less shares or vice versa. Either way, in this case, owning more shares is great because over the long term, the more shares you have of a specific investment, the more you'll benefit from the increased value of that investment option.
Now, on top of the fact that using a dollar cost averaging approach could potentially lead you to owning more shares with the same amount of money, one of the pros of dollar cost averaging is that it stops you from attempting to time the market. Timing the market is what active investors do in an attempt to beat the market. It involves guessing when the market is at its current low point and only buying investments at that point. The problem with attempting to time the market is that we don't actually know exactly when the market is at its current bottom or when it's at its current peak. Like we said before, people try and guess these peaks and bottoms, but that's exactly what it is. A guess. So when you're trying to time the market by buying investments when you think the price is at its current bottom, or avoiding buying investments because you think the price is at its current peak, you'll likely never be spot on and instead are more likely to miss out on long-term returns by not continuing to invest consistently. There's actually a really interesting chart that shows the potential impact on your overall stock market investment portfolio if you miss out on buying investments on the best 5 days, 10 days, 30 days, and 50 days in the stock market over a 50-year-long period. So think of the fact that over a period of 50 years, your money is invested for thousands of days. But if you miss out on 5 to 50 of those days, your overall return could be drastically different. What this means is that time in the market is better than timing the market because you can't. And dollar cost averaging allows you to take advantage of time in the market. Now, the main reason that you might use a dollar cost averaging approach is because you likely make money from your job on a consistent basis. You probably get paid once or twice a month and invest a specific amount of money from your monthly income. This is the most common case for the vast majority of people who work regular jobs. So if you make money every month and you invest a set amount of money each month on the same date, which would be sometime after your pay gets deposited into your account, then you're essentially following a dollar cost averaging strategy, as long as you're investing on a set date every month and you're not trying to time the market and pick the best date. This approach is great because it means that you're investing as soon as you can each month after you're paid and you're being consistent. And consistency is key when it comes to long-term passive investing specifically.
The second investing approach that we want to talk about is lump sum investing. Lump sum investing is a strategy that involves investing large amounts of money all at one time. It's pretty much the opposite of dollar cost averaging. Now, keep in mind that large amounts of money is definitely relative to you and your personal situation, but in general, investing everything that you have to invest all at one time would be a lump sum investing approach. Now, most people don't have massive lump sums or big chunks of money to invest all at one time. Instead, we make money and then we spread it out between our expenses and our savings. But if and when you do have lump sums to invest, like maybe you get a bonus from your work or an inheritance from a family member, or you get a tax refund, or basically any other reason you can think of where you'd have extra money outside of just your regular paychecks and income, then it's usually best to invest it all at once. Let's break down why that is. Earlier, we mentioned that the benefit of dollar cost averaging is that sometimes you purchase investments when the market prices are low, and sometimes you purchase investments when the market prices are high, but overall you benefit from not missing out on when the prices are lower. And it's great that this strategy can pay off literally because most people make and invest money consistently anyways. But if you have money ready to invest, research shows that investing it all at once and taking advantage of it being invested longer is typically better than spreading it out and having it sit in cash just losing purchasing power when it could be in the market. What that means is that when you invest a lump sum of money all at once, you're getting that money invested in the market as soon as possible. And like we said earlier, time in the market is better than timing the market. In theory, with dollar cost averaging, even though you're not investing based on the current price, instead you're investing at a predetermined frequency, you are trying to benefit from spreading your money out. And from the idea that you'll get to purchase investments when they're at a lower price sometimes. Plus, a lot of us don't really have any other option if you're someone who works a regular job and gets the typical bi-weekly paycheck. With lump sum investing, you're not timing the market at all. Instead, you're getting your money invested as soon as you possibly can. The research I mentioned is from a variety of studies that all find that lump sum investing tends to perform better than dollar cost averaging the majority of the time. Not always, but more often than not, having all of your money invested and not sitting in cash waiting to be invested tends to turn into better results. You're basically capitalizing on time in the market over the long run. The one caveat is that you could potentially end up making your lump sum investment on a day when the market prices are particularly high or even right before a market crash. But remember that since you're a long-term investor, the market will ideally rise over time. And even though you might be purchasing investments on a day where the price is high compared to the months ahead, it's still likely going to be a lot lower than when it's time for you to retire and actually sell your investments. Also, if you're investing for the long term and you genuinely feel comfortable and confident with what you're investing in, ideally passive funds that track the market, then investing a lump sum of money shouldn't feel that different than investing smaller amounts over a long period of time, like dollar cost averaging.
Keep in mind that most of the time, like we said earlier, people make and invest money on a monthly basis. We don't get massive lump sums to invest all at once. But when we do, instead of keeping a lump sum in a savings account and slowly investing a little bit of it until it's gone, research shows that it's likely better to invest it all at once. So based on the research that we're referencing, for your consistent month-to-month investing where you get paid and you allocate a certain amount of money to invest, using a dollar cost averaging approach is great. And then whenever you receive additional money, you can use the lump sum approach and invest it all at once to take advantage of time in the market. Please keep in mind that nothing is guaranteed with investing. Although this is a research-backed approach, we can't promise that this will 100% be the best approach in hindsight. So please keep that in mind as you invest. I actually want to mention that we've actually had this question ourselves in the past. Earlier this year, Steph switched up her investment strategy and she ended up with about $50,000 to reinvest. She initially felt more comfortable using a dollar cost averaging approach, so we're talking $10,000 a month over a 5-month period, instead of investing it all at once. In hindsight, she realizes that she likely would have been better off investing the entire lump sum all at once, and that's the approach that she's actually switched to and will be using in the future. The other thing I want to mention is that we're talking about this from the perspective of being long-term investors, and we know that as long-term investors, meaning that we're going to be investing our money for decades, we shouldn't be worried about short-term price fluctuations or dips in the market, or if our money would have been slightly better off had it been invested on a different day. Instead, we should only care about the long-term result. And that means that even if your money would have been better off had it been invested on a different day, your investments ideally would have still grown substantially over several years or decades from now. All right, so we hope that this answered all of your questions on dollar cost averaging and lump sum investing. If you have any other questions, make sure you ask them down in the comment box below. And make sure you check out our other investing videos, like the one that we just posted on dividend investing. Make sure you check that one out. And yeah, we'll be back next week with another video as usual.